Today we will be discussing the investing and financing sections of the statement of cash flows. We already introduced these sections in the introduction video, so make sure to go back and watch that video if you haven't already. As a brief review, investing activities can be broken down into three categories, which are all inclusive in terms of what you'll be seeing in this class. You should be looking for cash related to changes in 1. Long-term assets like equipment, buildings, or land, 2. Short or long-term notes receivable, 3. Short or long-term investments not classified as trading securities. Now I've kind of double counted here because long-term notes receivable and long-term investments are technically long-term assets which are covered in the first category, but I just wanted to be really clear that the long-term versions of these assets are also included. As for financing activities, the easiest way to break them down is to look for cash related to changes in 1. Long-term liabilities like bonds payable, 2. Short or long-term notes payable, 3. Equity like cash dividends or cash received from issuing stock. In order to complete the investing and financing portions of the statement of cash flows, you will need to use an income statement, beginning and ending period balance sheets, as well as additional information that will be given related to investing and financing activities. It can be helpful to recreate the journal entries related to many of the investing and financing transactions, and some teachers require journal entries when completing the statement. Let's continue with the example we started in the previous video. I encourage you to download the resources associated with this video since I can't fit everything on the screen at once. Right now I just have the income statement and the statement of cash flows, but I also have a balance sheet sitting over here, and then there is some additional information that I'm going to be flashing on the screen as we go here. So usually what I do is I look at the additional information one piece at a time, and most of it will concern either the investing or financing activities, and that will get you most of the way, if not all the way done with these two sections. The first piece of additional information tells us that equipment costing $15,000 was sold for cash. Now we know that equipment is a long-term asset, so this is going to be an investing activity. Our goal here is to figure out how much cash was received for the sale of equipment here. And we're going to do that by recreating the journal entry associated with this transaction. Now you may recall that the journal entry related to the sale of equipment includes a debit to cash, which is really the only part we're interested in here. We want to know how much cash was received for this equipment. But we're going to have to fill in the other blanks, so they also include a debit to accumulated depreciation for however much depreciation has been recorded on this piece of equipment. We're going to have either a gain or a loss, or possibly neither if it was sold for its book value, and then a credit to the equipment account. Now the only one we know so far is the credit to the equipment account is going to be for $15,000 because the additional information told us that the equipment had originally cost $15,000. So the idea here is if we can figure out what the accumulated depreciation and the gain or loss is, then by balancing the journal entry we can figure out how much cash was received. So we're going to use the income statement and balance sheet to figure out those missing numbers. First, if we look to the income statement, we can see that we have a gain on the sale of equipment for $2,000. So that solves one of those blanks. We know that we have a gain on the sale of equipment, which is going to be a credit for $2,000. Now the accumulated depreciation in the journal entry is a little bit more difficult to find, but we can still get there by manipulating a known equation. We know generally that the accumulated depreciation account only changes in two ways. It increases whenever we record depreciation expense on our assets, and it decreases whenever we sell an asset that has been depreciated. So that gives us the formula that the ending balance for accumulated depreciation in a period, abbreviated by AD, is equal to the beginning balance of AD plus depreciation expense minus the AD on equipment sold. The number we need is the accumulated depreciation on the equipment sold, because that's the journal entry that we're doing. So if we rearrange this formula, we get that the accumulated depreciation on equipment sold is equal to the beginning balance of accumulated depreciation minus ending balance of accumulated depreciation plus depreciation expense. Whoa, I know that was a mouthful, but this is the important formula that we need. So make sure that you have this one written down. The numbers that we need can be found on the income statement and the balance sheet. So I'm going to move over so we can see both of those at the same time. So if we look to the income statement, we can see the depreciation expense right here is for $4,000, so we can fill that into our formula. And we can also see that the accumulated depreciation in 2019 was $12,000, and in 2020 it was $8,000. So we have 12,000 minus 8,000 plus 4,000 equals $8,000 accumulated depreciation on the equipment that was sold. So we do need to assume here that there was only one piece of equipment that was sold, because otherwise the $8,000 could be split amongst multiple pieces of equipment. So anyways, this is the number that we need for our journal entry. So we can plug that in for our debit to accumulated depreciation. So now all we need to do is to figure out what amount for cash would make the journal entry balance. And hopefully you can verify that $9,000 is the correct debit. So now we know we received $9,000 for the sale of equipment. So let's go back over here to our statement of cash flows, and we can put cash received from sale of equipment, and that's going to be for $9,000. Alright, the next few transactions are going to require me to use the balance sheet. So I'm just going to move the income statement down here and grab the balance sheet. So that's going to be a little bit easier for us to see everything. Now before I even give you the next piece of additional information, I want you to notice something about the equipment account here. Based on the last transaction, we had $15,000 worth of equipment which was sold. So if that was the case, then the $50,000 balance in equipment should decrease by $15,000. So $50,000 minus $15,000, that tells us that we should have a balance of $35,000 in the equipment account. But that's not what we see. We see a balance of $45,000. So that suggests that $10,000 worth of equipment was purchased. So let's bring in our next piece of additional information. It says that all equipment purchases are for cash. Well, we just determined that $10,000 worth of equipment was purchased. That tells us that, well, we had $10,000 paid for that equipment that was purchased. So our next piece of information here, our next line on the cash flow from investing activities, is going to be cash paid for equipment. And that's going to be for $10,000, so minus $10,000, since that's a payment of cash. And if you are interested, the journal entry for the purchase of equipment is showing on the screen now. It would just be a debit to equipment for $10,000 and a credit to cash for $10,000. Next, we are told that common stock was issued at par value for cash. So let's take a look at the common stock account. We see that common stock had a $106,000 balance, and then it had a $116,000 balance. Well, that's a $10,000 increase in common stock, and we're told that that is for cash. So this is actually going to be a financing activity because this is related to equity. So let's go down here. So this is going to be cash received from issuing common stock. And this is going to be for $10,000. And again, if you were interested, the journal entry related to this transaction would include a debit to cash for $10,000 and a credit to common stock for $10,000. The next piece of information says that the only items affecting retained earnings are net income and cash dividends. Now, the part that could be related to cash here would be the cash dividends. And the thing is that cash dividends don't really show up on the balance sheet or the income statement anywhere directly. But we can figure out the cash dividend amount based on some information on those two statements. Notably, what we can do is we can use another formula here, and that is to find the ending balance retained earnings, we can take the beginning balance retained earnings, add the net income, and subtract the dividends paid. Now the number that we need here is the amount of the dividend payment. So just like earlier, we can rearrange this formula algebraically to find that the dividend payment is equal to the beginning balance of retained earnings minus the ending balance in retained earnings plus the net income. So all we need to do is to figure out what those balances are and plug them into the formula. So since we have the balance sheet up right now, we can see that there is the retained earning balance for 2019. That's going to be our beginning balance amount. And we have the 2020 amount at $11,000, so we can fill in both of those. And if we scroll down to the income statement, we can find the net income, which you may have remembered was $5,000. We already used that earlier in the statement. And if we plug in those numbers, we get $7,000 minus $11,000 plus $5,000 equals $1,000 paid for cash dividends. And you may remember that the payment of cash dividends is considered a financing activity. So let's go down to our financing section, and we can put in cash paid for dividends. And that's going to be negative $1,000. And the journal entry for the payment of cash dividends is showing on the screen now. we would have a debit to retained earnings for $1,000 and a credit to cash for $1,000. Alright, we are on to our last piece of additional information, which says that some bonds matured and were paid off at face value. So if we take a look at our liabilities here, we see we have bonds payable, which started at $20,000 in 2019 and then had a balance of $14,000 in 2020. So the difference between those two numbers and the amount that was paid in cash is $6,000. So this is going to be a financing activity as well, since this is a change in long-term liabilities. So what we will put here is cash paid to retire bonds payable. And that's going to be for negative $6,000. And the journal entry for that one, if you were curious, is a debit to bonds payable for $6,000 and a credit to cash also for $6,000. Alright, that is it for the additional information, but you may or may not be done. It's still a good idea to glance back at your balance sheet specifically to see if there are any other pieces of information that weren't really reflected in the investing and financing activities that you might need to take care of. And just kind of glancing here, looks like we had land, which could have maybe fallen under the investing activities, but it looks like the balance didn't change at all, and we weren't told about any sales or purchases, so this looks like we don't have to do any adjustment there. We've already dealt with all of the, the current assets and liabilities in the earlier section, so there's not really anything else to do with those. Bonds payable, we've already dealt with that. We dealt with the change in common stock, and we also dealt with the change to retained earnings. So it looks like we have covered everything. So the next thing to do is to get some totals. So first, for the investing activities, we can take the 9,000 and subtract the 10,000, and that will give us negative 1,000, which we can put over here. And since this is a negative number, we're going to put net cash used by investing activities. And we can do the same kind of idea here down for the financing activities. 10,000 minus 1,000 minus 6,000, that is going to give us positive 3,000. And since that's a positive number, that will be the net cash provided by financing activities. And I already have the title listed here. Alright, we are so close to done. The next thing we need to do is add up the totals for each of the sections. So kind of scrolling up here, we have the net cash provided by operating, which was 8,000 minus the 1,000 from investing, plus 3,000 from financing, and if you do the math there, you should be left with a positive $10,000. And since 10,000 is a positive number, the label that we use here is net increase in cash. And if we had a negative number, then we would use net decrease in cash. And the last two labels that we need are the cash balance at prior year end and the cash balance at current year end. And these are just kind of checks to make sure that you did the statement of cash flows correctly. So if we look back at the balance sheet, we'll see that the cash balance as of the prior year end, which is 2019, was 34,000. So let's copy that down right here, 34,000. And the cash balance as of the current year end, which would be 2020, is 44,000. So we're going to put 44,000 right here. And we can see that we have done this correctly, right? Because the difference between the current year end and the prior year end, if we subtract those two numbers, we do get the $10,000 increase in cash. So that's a good way for you to check yourself when you're done with the statement of cash flows. Alright, we are finished with the statement of cash flows. Now just note that I haven't given you every transaction that you might see in the investing and financing sections. There are many other transactions that you could see. And in the practice problem associated with this video, you will see a couple of other transactions that we didn't use here. Alright, that wraps up our video for the investing and financing sections of the statement of cash flows.